And with us, we've got Grant Fagerheim. He is President and CEO of the company. Much like all the other sessions today, we're not going to do a formal speech or presentation. We'll go straight to Q&A. If you do have any questions, there is an option at the bottom left-hand side of the webcast. Punch in the question, we'll try to address it there. And we've only got 20 minutes, so I'll jump right to it. Grant, in March and April, WCAP announced some pretty significant reductions to the capital program, to the dividend, 50% cut to the dividend. Obviously, the world's a little bit better today than it was in March and April. Just wanted to get a sense of, when and what price maybe you think about revisiting both the dividend and your capital program.
Okay, thanks, JJ. So we are very focused on generating returns on capital employed, and therefore we've made the conscious decision to remain on the sidelines from a capital perspective until we see WTI prices sustained for a 2 to 4 week period of time in the $42 to $45 WTI range. With the WTI price volatility as well as with the wide ranges of pricing differentials, we are electing to a more conservative than aggressive, being more conservative than aggressive at this time. We're not expecting to be putting drilling capital to work in the third quarter. However, the fourth quarter looks to be possible. Failing that, we will delay until sometime in 2021 when the price signals justify the increased capital spending.
And, at what point do you start to think about growth capital? Is that still the $42 to $45 price, or do you want to see a little bit higher than that?
Yeah, no. In that particular range, what we're thinking is that at $45 WTI, we can generate acceptable enough returns on the inventory of opportunities that we have. We think that over 70% of our inventory have rates of return in excess of 30 to 40% at that $45 WTI level, profit to investment ratio of 0.5, and we get our money back well within a 2-year period of time at those levels. So we think we've got a strong enough inventory, but there's no sense capitalizing on those at this particular time when we do have this volatility in pricing. So we're looking for the returns when we can possibly deploy capital.
Yeah, that makes sense. And you touched on a point on inventory. I mean, M&A is clearly a theme in the basin. WCAP's had a pretty significant role in it, outside of the last couple of years. One of the things we hear a lot is bid-ask spread is still too wide, et cetera. But, we are starting to see a few transactions in the space. Just curious what your thoughts are there and what kind of role you anticipate playing in the next couple of years.
Okay, sure. As we think forward about how to best position WCAP for a recovery, whenever that might be, we do think that size, scale, and relevance matters. Not for the sake of just being more sizable, but for a more efficient, both operationally and corporately, but also the ability to take a long-term commitment for contracting for services with respect to downstream transportation and storage. We think consolidation in the industry is important, and we think we can play a role in that. However, given this current volatility that we just spoke to and uncertainty surrounding the timing and shape of recovery, in the near term, it's difficult for transactions to happen from our perspective. As we move into the latter part of the year, into 2021, we think M&A will again pick up the pace. Key considerations, obviously, we want to make our company stronger, not weaker. The other considerations are the assets and the commodity type, geographic concentration, return profile of the acquired assets, and we operate things differently than most companies. So we look to post-acquisition operating strategies, and then of course you're going to have to look at financing options and structure, debt, equity, contingency payments, convertibles. You're going to have to look at everything to make sure that you're making your asset base stronger for your shareholders on a go-forward basis.
So you touched on commodity mix, which I think is interesting. I mean, there was a bullish natural gas call earlier this year, as oil prices obviously had some weakness. And it reminded us of some of the benefits of having a multifaceted, I guess, asset strategy than just being a pure play. Has that changed? I mean, obviously you're an oil-focused company. Has that changed the way you think about natural gas? And, could that become another leg to the stool at some point?
Yeah, as you've noted, JJ, natural gas prices have fared far better through this COVID-19 pandemic and oil glut time period. And we are of the opinion that light oil remains the product of choice as a result of the high netback, along with the potential for secondary and tertiary recovery methodologies. We do believe that this remains. However, as we look to the next sustainable growth phase for Whitecap, we have undertaken a deep dive review of the natural gas projects that might be out there, as long as they have associated liquids opportunities with them. As we're a return-based organization, we have internal discussions about possibly diversifying our portfolio somewhat into liquids-rich natural gas projects, but that's early stages on this, but something we are considering as we move through the back half of 2020 into 21. And as you're aware, JJ, Whitecap runs a fully funded model, which means despite commodity prices, our objectives are to have a total payout ratio of less than 100% after accounting for capital and dividend payments. What we've seen with the collapse in oil prices is the importance of having high cash flow netbacks. Whitecap has only had to shut in less than 3% of our production, or 2,000 barrels a day, for economic reasons, as our break-even at the asset level is very low at $16.50. So that still continue to generate positive cash flow at those levels. So light oil generates much higher netbacks than heavy oil or natural gas. With respect to natural gas, unlike crude, there's no opportunity for secondary or tertiary recovery, which is important to us on a go-forward basis. We would, however, be interested in liquids-rich fairway that come with more associated natural gas, similar to the Montney farm-in we completed in 2019.
So that's actually a good segue into my next question, but before I go into the Montney, are there any characteristics that you would look for? I mean, obviously the returns have to compete on an asset basis with your existing portfolio, but what kind of characteristics would you look for? You touched on NGL-rich natural gas projects. Is there any other color that you can provide that you feel would fit your portfolio?
The key component for us is when we're looking at assets, we want them to be able to survive on their own. In essence, be able to grow modestly within their own cash flow and have the ability also to spin off a dividend. So, what we look like is somewhere in the neighborhood of not greater than 75% of its own cash flow to be able to grow modestly. We're not going to be able to grow those assets aggressively, but we think we can grow those modestly and then put, because we do pay a dividend on a consistent and growing basis. So those are we can talk about the capital metrics or cash flow metrics around each one, but our key components are that each of the assets can survive on its own, within its own cash flow. And it has been the key since we started Whitecap back in 2009.
And, you touched on the Montney. Clearly you did the farm-in last year. Things have changed since that time, but, can you comment a little bit about the results, how they've been? Clearly it's a play that you've got your eyes on, how you think that the Montney can feature in your portfolio in the next couple of years?
Sure. We're pleased with the results we've experienced to date. However, we do feel that the first two wells that we participated in can be improved on geographically, as they were drilled on the eastern extension land block furthest from known production and geology. The first well that we didn't drill but was drilled by our partner and completed is currently shut in for breakup and should be back on shortly, even later this week or early next week, weather dependent. The first earning well that we drilled and completed has recovered about 50% of its load fluid to date, so we continue to produce that at this particular time. The second earning well we drilled is awaiting completion, which we've deferred until prices improve, possibly in the fourth quarter, as we're talking about above $45 WTI oil, or sometime into 2021. The results are limited to this point and very, very early days, but we remain very positive on the play and believe it will provide significant growth for us into the future. We'll wait on higher crude oil prices before increasing capital expended in this area and on these lands.
And you mentioned $45 is kind of where you'd start, one, you'd complete that second well and perhaps accelerate that program. One of the things, some of the other Montney producers have experienced is, the high growth came at a higher cost in terms of decline rates. How do you rationalize a potentially higher decline rate of an asset like this, which you look at developing organically versus your existing decline rate, which is on the lower end, obviously?
Yeah, it comes back into portfolio management, and if we can talk about it in that context, part of our overall objective here is to keep our decline rate under that 22 to 23% range, and that's we exited the first quarter at 19 to 20%. We think we're in that neighborhood right now of around 17 to 18%, and by the end of the year, with a limited amount of capital we're spending, we anticipate to be between 13 and 14% decline rate, 13 to 15% if you want to be on the high side. So the key that we look at is if we go through our assets, Southeast Saskatchewan asset has a decline rate between 3 to 5%. You go upscale to Southwest Saskatchewan, current decline between 10 to 11%. You continue to, as we increase in decline rate, our West Central Alberta Cardium assets between 18 and 19%. Northwest Alberta, British Columbia, we're in the neighborhood of 20 to 21%. And our West Central West Central Saskatchewan Viking is declining at about 36 to 37%. So with a blend of all of those, and in the Northwest Alberta, we haven't included any of the portfolio as yet because we were planning to do that, and then commodity prices dropped. We'll look to add that back in on the joint venture once we, ourselves and our partner Hammerhead, decide to bring capital back into the fray. But now isn't the time to do that, we don't think.
And you mentioned, by year end, you're expecting a 13 to 15% decline rate. Obviously that has a material positive impact on maintenance capital. Any kind of color you can give us as to, what the implications are for next year, what you would anticipate maintenance capital would look like under that scenario, based on your Q4 production volumes?
Sure. Exiting this year with this minimal amount of capital that we're spending, and I should have said we're about $5 million a month at this particular time, and about 50% of that is on CO2 purchases for our CO2 sequestration project at Weyburn. The balance that we're spending is not really on capital, but we do capitalize asset integrity, which is a key component, and that's why we can't say exactly when we're spending it. Is dependent upon when we can be in the field. So on exit this year, we're anticipating to be somewhere in the neighborhood of 60,000 barrels a day with the limited amount of capital that we're spending for the remainder of the year. And at a $45 WTI oil price, we're looking between $200 to $240 million of capital. Now, what we're using as an estimate at this time are what the service costs were in the first quarter of this year, 2020, when everyone was pretty active. We don't know if that changes, but that's what we're carrying at this particular time. And there's no sense for us to go back into and start talking to the service sector until we put a continuous program together. So we haven't even entered into, are those prices that we had in the first quarter, are they going to stick and stay? Are they going to be lower or higher, or what they're going to be? So overall, this is where we talk about this, somewhere between $42 to $45 WTI oil. We can maintain our production, maintain our dividend, and actually continue to focus on balance sheet strength. This year, for example, we're actually looking, we have free cash flow, even in this pricing environment, we have free cash flow in the neighborhood of just slightly over $100 million. And we prioritize that to put it on to our bank line. So not that we've got a debt issue, but that's where we prioritize it to go at this particular time. Commodity prices come back, we'll start to capitalize our assets again, but at between 42 and 45, we keep our production whole flat, but whole from the end of the year, and our dividend flat as well.
You touched on costs, which is interesting. You've also made, or Whitecap's made, some significant strides on the operating cost front. Just curious, if you can comment on how much of that is sticky, how much of that could come back in a better environment. That's essentially what I'm asking. How much of that,
Sure.
is here to stay?
Yeah, we think on the cash reductions. G&A, we removed $8 million out of our G&A. We think that's very sticky. On the operating cost side, $42 million cash reduction for the year 2020. Now, we're estimating somewhere around that 25% of that cost would remain out of, and we ultimately think that as we come back, if prices increase and activity starts to improve again or increase again, that we would lose probably 70 to 75% of that reduction. So we're thinking in real terms, if we say that $42 million, we think that about $10 to $11 million of that loss out of our operating costs will be permanent.
We've got a few minutes left. I do want to talk a little bit about Weyburn. I think, in the environment today, it's been hard to talk about ESG because, commodity prices and what have you, some of the other challenges in the pandemic. But, Whitecap's doing some really great work at Weyburn. I'd like if you could spend a few minutes highlighting what exactly you're doing and some of the benefits that you can point to investors on that front.
Sure. Okay, thanks, JJ. We're of the opinion, first of all, that the environment will continue to be exposed to increased narrative. We also feel that it's important for energy companies to demonstrate their current status with respect to emission monitoring and management, along with their targeted initiatives for the future. So we are the owner and operator of the Weyburn unit in southeast Saskatchewan, one of the largest carbon storage projects in the world. Annually, we sequester and store approximately 2 million tons of CO2, exceeding the company's total greenhouse gas emissions of 1.4 million tons in 2019. So net negative emitter of 600,000 tons of CO2. So while many of the companies have disclosed goals of carbon neutrality, we're currently sequestering more CO2 than we emit. So recently we released our sustainability report, where we have set a formal target to reduce our emission intensity by an additional 20% by 2023 from 2019 levels. We chose 2019 as a base year to focus on new reductions rather than accounting for reductions already achieved. Since 2017, we reduced our emission intensity by 37%, and when we reach our target in 2023 or before, we will have achieved 50% reduction over the 6-year time period. So now, are we expecting to do more at Weyburn? Not necessarily more at Weyburn, but on many of our other assets where our greenhouse gas emission reductions plans that we do have in front of us.
And
I think JJ,
yep.
I think it is important to note that Canadian energy producers perhaps have the safest and most rigorous guidelines with regard to safety, environment, and environmental stewardship guidelines in the world, and should be recognized as such. I'm very proud of our Canadian energy producer sector and not only what Whitecap does, but what a lot of the producers do out there.
So on that front, are you finding that investors are coming to, understand, some of the strides that you're making at Weyburn and the negative carbon emissions, et cetera, or is that still feel like somewhat of an uphill battle? Like, what's your sense been?
Yeah, we don't really, very seldom are we asked about the Weyburn asset, and very seldom are we asked about our emissions. But we think it is important, and we'll, as I say at the onset here, we do think that the narrative continues to increase on the environmental stewardship. So we don't think it's been it certainly hasn't been a differentiating factor to this point, but maybe it will in the future. I think there's, we believe that if it is going to be, we should participate in it on a go-forward basis.
What are your thoughts on M&A, further M&A at Weyburn, given that there's still pretty fragmented ownership structure there.
Yeah, for the right price, I mean, obviously, we look at that asset. I mean, we own 62.11% of it at this particular time, and as we look to roll out other CO2 initiatives in and around that area, we're always looking to see if we can add to our interest there. But those interests have to be brought in at a cost that is acceptable to not only to us but to our shareholders. So. Do we think there's 23 owners in the unit at this particular time, including ourselves? So do we think that it could be consolidated up? Yeah, probably should be, but there is a price for that as well. And in this particular pricing environment, it becomes more and more challenging.
Well, that's all the time we have today. Grant, thank you very much. Thanks for everybody for dialing in. If there are any